The operating cycle is the average time between when a company acquires materials and supplies and when it receives cash from the sale of the products. And here we see a visual of the operating cycle here. So the company begins, when it's a brand new company, bringing in the raw materials. Then it converts those raw materials into work in progress and, of course, finished goods inventory. Those finished goods inventory are on sale to the customers, and then ideally, right about this point here, there's going to be a sale. And the inventory comes off the books. Cost of goods sold, the expense is recorded on the income statement. The company recognizes sales revenue and accounts receivable. We see the receivables here. Eventually, those receivables are collected by the company in cash. If those raw materials had been purchased on account, that some of that cash is used to repay those accounts payable. So we see when we're talking about the operating cycle, we're talking about the current assets, cash, accounts receivable, and inventory, and the current liabilities, accounts payable, and perhaps accrued liabilities, including salaries and wages payable and utilities payable. Management's objective is to shorten the operating cycle. Why is that? Well, the net result of the operating cycle, each time we go through this cycle, what are we capturing? Well, we start off with, when we get our sales, we have to pay for the cost. Here's our sale. We have to pay for the cost of the sales, the inventory, the cost to produce that inventory. And then that gives us our gross profit. Now, we also have to pay our employees that are helping us with the sales. We have to advertise, and so we're going to incur some operating expense. And then the net result is our dollar amount of operating income. So every time we complete this operating cycle, we're earning gross profit and operating income. So the faster we can get through this operating cycle, the faster that we'll be able to record gross profit, operating profit, and net income. So the faster we can do that, the more net income we're going to have. Now let's talk about liquidity. Liquidity refers to the availability of cash. It describes the amount of time expected to elapse until an asset is either sold for cash or received in cash. So what are we talking about? What assets are sold for cash? Typically inventory. We don't want to include plant, property, and equipment. Ideally, a company is not in business or doesn't raise cash by selling off its plant, property, and equipment. And what do we mean by received in cash? Accounts receivable are assets that are received in cash. So liquidity describes the amount of time expected to elapse until the asset is sold for cash, received in cash, or until a liability is paid in cash. A company that has high liquidity is better able to withstand a financial downturn because it doesn't need to go out to the market to raise excess cash. It has enough cash. And in addition to that, it has a better chance of being able to take advantage of investment opportunities that arise. So if a company wants to be able to quickly create a new product and offer that, if it has excess cash in order to, let's say, hire people or buy the raw materials or advertise, it can then do so. Let's talk about working capital, also referred to as net working capital. Working capital is the difference between current assets and current liabilities. Why are we interested in that comparison between current assets and current liabilities? Well, those short-term debts, the current liabilities, are typically paid for with cash. And think about the most basic current assets: cash, accounts receivable, which will soon be converted or collected in cash, and inventory that will either be sold directly for cash or sold for an account receivable, which will then be collected in cash. It's a measure of how well the company is managing its cash, so that it can meet short-term obligations, pay its short-term bills. And one thing to remember, we're going to be looking at various measures of liquidity, the working capital being one of them. It's measured as a dollar amount, and therefore it doesn't account for differences in the size of the companies being compared. So if you see one company with $1 million in working capital, it doesn't necessarily mean it's a safer company than a company with $100,000 in working capital. Because really we need to take into consideration how big are these companies. The bigger the company, the larger the dollar amount of working capital that we would expect. The benefits of having greater amounts of working capital, these are not going to come as any surprise, but with more working capital, the company would have lower risk of not being able to meet its current obligations. In other words, lower risk that it's not going to be able to pay your bills as they are coming due, and therefore lower risk of needing to take out new debt. What would a company need to do if it doesn't have enough cash? It would need to take out a new loan, and or issue new shares of stock, and or sell off assets. We don't want the companies to have to run into that situation. Another benefit of having more working capital, having your current assets greater than your current liabilities, is a greater ability of obtaining short-term financing. You've probably heard the saying that you have to have cash in order to be able to borrow cash, and this is where we see this. But there are costs of having a lot of working capital. The costs are not as obvious as those benefits were. What are the costs of having a lot of working capital? Well, the net current assets, in other words, the current assets less the current liabilities, or the working capital, it must be financed somehow. Must be financed with current liabilities, long-term liabilities, and or stockholders' equity. These items, liabilities, especially the long-term liabilities and stockholders' equity, these come at a cost to the company. There's a cost of equity, and of course that there's the interest cost that results from debt. As we go through these various measures of liquidity, let's work through together an example for the company Movado, the watch company. So here I have my analysis. Movado, I'm going to fill in these numbers as we go along, and I've already filled in the numbers for a competitor fossil company. So working capital is simply going to be total current assets minus total current liabilities. Again, this is a dollar amount. So I can look at the trend. How did working capital change over the period? It increased from 355. Let's see, these numbers are in thousands. So 355 million up to 374 million. I can compare that to fossil, which had a decrease in working capital. Their working capital decreased from 652 million down to 432 million. Now, is this decrease a red flag? It's hard to say. And is this increase a good thing for the company? So let's look at Movado first. We had an increase in working capital. How did the company change in size? I'm going to look at total assets. So the company overall got bigger over the period, and its working capital got bigger as well. So there's no concern here. If I look at fossil and I see a large decrease in working capital, I want to know, how did the size of fossil change? I see that the company is getting smaller over the balance sheet period that we're looking at, but its working capital is also decreasing. So I know that the company is kind of getting smaller in size. If the company had been increasing while its working capital was decreasing, that might be a bit of a red flag. But what we see here is the changes in working capital are fairly consistent with the changes in the sizes of the companies. Let's move on to our next discussion of, we're going to look at some specific current assets, cash, accounts receivable, and inventory. How do we manage those, both from a company's perspective, because when we're doing the books for a company, we're in their financial reporting department, we want to make sure our company is being successful. We want to be able to evaluate the changes in balance sheet items for the companies. And also as an investor, we want to be able to look at the financial statements and be able to see was the company being more efficient or less efficient with the investments on the balance sheet. Companies face a trade-off between safety, having enough cash to be able to pay bills, and efficiency. What are we doing with that cash? I don't want the companies that I'm investing in to hold enormous amounts of cash because that's simply not productive. I want them to take my cash when I buy shares of stock and use that cash to invest it in their productive operations and earn a return for me. We can call this efficiency or productivity or profitability. So similarly, the risks of holding too much cash, interest on debt. Company might have a lot of cash, but it also might have debt outstanding. And that interest on the debt is likely to be significantly higher than the interest revenue earned on cash if it's invested in, let's say, a money market account. As we said before, another risk is that that cash can be used for more productive purposes. And from an investor's perspective, what do investors think? Investors say, I'm not giving you my cash to manage. I can manage my cash myself. So if you have excess cash, you can either pay it to me in a dividend, let me do something with the cash, let me make my choice. And in addition to dividends, another way that companies can return cash to their stockholders is to buy the shares back. When companies buy their stock back, it tends to increase the price of the stock. And then so for the investors, as the price goes up, investors might want to sell for a higher price and capture that gain. A couple ways for companies to be able to increase cash in the operating cycle. Now, this doesn't mean we can't force more customers to come and buy our product. And we're talking about the operating cycle, so we're not talking about going out to a bank and taking out a long-term loan or note payable. One is to work on improving collections of accounts receivable. And we'll talk about that in just a moment. And another is to delay cash disbursements where possible. And what we mean by the cash disbursements are payments to suppliers. And we'll talk about that in some more detail shortly. First, let's get started with talking about managing accounts receivable. A major determinant of sales is a company's credit policy. Who are we going to sell to on account? Who are we allowing to buy our products and not pay us cash immediately? Companies face a trade-off between how liberal its credit policies are or let's say the more liberal a company's credit policies are, the higher the sales are going to be. The more people we're extending credit to, the higher our sales dollars are going to be. But what's the problem here? The more liberal we are with our credit policies, the lower the likelihood of collection. We're going to end up with some bad debts. So on the other hand, we can have very stringent or strict credit policies, but we're going to miss out on some sales. So managers and investors, when we're evaluating accounts receivable, need to find some middle point between having the right amount of credit policies so that we have the optimal amount of sales dollars and the optimal amount of likelihood of collection. Some ways that companies can help speed collections and ensure that they're getting cash from their receivables. One is to reduce the credit period. The credit period is the length of time buyers are given to pay for their purchases. Another is to strengthen credit standards. In other words, how high of a credit score, let's say, do our customers need in order for us to sell to them on credit? The higher the credit scores allowed, the faster and more likely we are to collect from them. Another option is to offer discounts to our customers so that they pay early. We really have to think about this because, of course, we're going to be giving up cash if we're offering these discounts. We need to think about what is that opportunity cost to us. If we did not get the cash, let's say within 45 days, what are we giving up? Where could we have invested that cash more productively? And then finally, another way for a company to speed up collections is to sell those accounts receivable. And we call that factoring. Selling accounts receivables to a third party. And that third party we call a factor. So we're going to sell these receivables. We're going to get the cash up front. We don't have to wait around for our customers. The factor will have to wait around for the customers to repay. But of course, the factor is going to charge us some fee for this. So this factoring is actually quite similar to a collateralized loan where they're paying up front minus a fee. And then the collections are going to be done over time from our customers directly to that factor. Evaluating accounts receivable. Accounts receivable turnover is a ratio that can be used to evaluate the effectiveness of a company's credit policy and accounts receivable collections. The accounts receivable turnover ratio is measured as a company's credit sales, and when we are analyzing companies' financial statements through the SEC, we typically don't find credit sales, so we typically use net sales, that top line on the income statement. If we're within the company, we can definitely get a better measure by looking at exactly what our credit sales, taking out our cash sales. There are no receivables related to the cash sales. Let's divide our credit sales by average accounts receivable. And average accounts receivable means let's take the most recent year's accounts receivable, that's an ending balance, plus the prior year's accounts receivable, that would be considered our current year's beginning balance, and divide by 2. Why do we take the average rather than the ending accounts receivable? Credit sales our net sales is the number that on the income statement. In our analysis, we're doing an entire year's worth of sales. So is it safe to say that the entire year's worth of sales relates to the ending balance in accounts receivable? No, it really relates to the average daily accounts receivable. But we can't get average daily. The simplest way to get a better measure than just the ending balance in receivables is to look at the beginning balance plus the ending balance, divide that by 2 to get the average. Accounts receivable turnover tells us the number of times of year that the company is converting its receivables into cash. We can convert the accounts receivable turnover ratio into a measure of the number of days after a typical credit sale is made until the firm or the company receives payment. So we're turning our accounts receivable turnover ratio from some number of times per year into a number of days. And the receivables collection period is 365, the number of days in our period when we're looking at net sales for the year, 365 divided by the accounts receivable turnover. And sometimes instead of using the term accounts receivable collection period, this is also known as days sales outstanding and days in receivables. They all mean the same thing. Do managers and investors prefer high or low values of the two measures we looked at for evaluating accounts receivable? One, accounts receivable turnover. Accounts receivable turnover, how quickly are we collecting our receivables? We typically want that number to be high. And these two measures are inversely related. So the receivables collection period we want to be low. We want the number of days that we're waiting to collect the receivables to be low, and the amount of time that we're converting those receivables into cash to be high. Managers, investors want collections to be fast, but of course they face the trade-off. If these collections are too slow or the time is too long, the company may be struggling to collect from its customers. And if the time is too short, the company's credit policies may be too strict. So what does that mean if the credit policies? Why would that be a bad thing? Maybe missing out on sales. Let's go to our analysis of Movado and analyze the accounts receivable turnover. Remember, accounts receivable turnover, we start with sales on the income statement, and we're going to divide that by average accounts receivable. To get my average accounts receivable, I can do that one of two ways. I can either type in average as a function, or I can take my account receivable in the most recent year plus the prior year, divide by 2. And I get 6.52 for the most recent year. And I see that there was a drop in the accounts receivable turnover period over the 3 years. To get the receivables collection period, which again is an estimate of the number of days that the company takes to collect on a credit sale, or in this case total sales, since we don't have credit sales, just about 56 days, and that is up from about 45 2 years prior. How does that compare to Fossil? I see their numbers are pretty similar. Fossil's receivables collection period is going up, while so is Movado's receivables collection period. They are both going up. And inversely, accounts receivable turnover for the two companies are both decreasing. Now let's talk about inventory management. Again, we're going to look at a trade-off. Companies face a trade-off between cost of holding inventory, and we call this inventory carrying costs. These include storage costs. We have to pay for our building and pay the utilities on the building, insurance costs, opportunity costs. If we didn't have so much invested into this inventory, what could we be doing with that capital? Obsolescence. As we're holding on to these goods, the demand for them might decrease as new products are being put into the market. And finally, spoilage. This is typically true for when we're talking about food and other goods that go bad over time. Yet, we want to have enough inventory to be available for all the sales. How do we evaluate inventory? The inventory turnover is a ratio that can be used to evaluate the efficiency and effectiveness of a company's ability to generate sales from the inventory it holds. The inventory turnover ratio is the company's cost of goods sold divided by average inventory. Again, we see here an income statement amount compared to a balance sheet amount. And because of that, income statement number is for, in our case, the full year. We want to get a better measure than inventory balance at the very end of the year, so we take the average inventory balance. We know that the purpose of holding inventory is that so we can sell it. So why do we use cost of goods sold as the numerator rather than sales revenue? What's the difference between sales revenue and cost of goods sold? It's the markup that we put on our goods. About how much do we mark the selling price above cost? So we want to be able to isolate that markup from just simply looking at cost of goods sold compared to the average inventory. Inventory turnover tells us the number of times per year that the company is that the company is selling its inventory. And just like we did with accounts receivable, we can also convert this. We can convert the inventory turnover ratio into a measure of the number of days that the company is holding on to its inventory. And we call this the inventory conversion period. The inventory conversion period is 365 because we're doing our analysis in 1-year periods. 365 divided by the inventory turnover ratio. Do managers and investors prefer high or low values of inventory turnover and the inventory conversion period? We want inventory turnover to be high. Every time we're selling that inventory, we're capturing the gross profit. And inversely, we want the inventory conversion period to be low. We don't want to be sitting on that inventory for too long. And again, managers and investors want inventory to be sold quickly, but they face the trade-off. Inventory selling too low or too slowly, inventory storage costs are high, but if they're selling too quickly, we may not have enough inventory to fulfill all sales. Let's continue our Movado example and look at the inventory turnover and inventory conversion period. Inventory turnover, I want to link to cost of goods sold or cost of sales and divide that by average inventory. I have inventory turnover of 1.46, which indicates that the company is only selling its total inventory about 1.5, and in prior years, 2 times a year. Without even looking at competitors, that's a relatively low number. We look at the number of days the company is holding on to its inventory, it's about 251 in the most recent year. So which company looks better, Fossil or Movado, in terms of its ability to efficiently sell its inventory? We see that Fossil looks like it's holding its inventory for a shorter number of days and turning it over faster. Operating cycle can be measured as the number of days that it takes a company to convert inventory into cash. Because remember what happens, the inventory is typically sold on account receivable, and then those accounts receivable are later turned into cash. So the operating cycle can be measured as the inventory conversion period plus the receivables collection period. And what we have with this operating cycle is again, notice a number of days. That's our result. Changes to inventory management and collection policies, receivables collection policies, are going to affect the operating cycle. Let's take a look at the operating cycle of Movado. We simply need to just add the receivables collection period plus the inventory conversion period. So we're saying when we have a sale, if all sales are on credit for the company, it takes the company the most recent year about 307 days to sell the inventory and then collect cash from the customers. This is significantly higher for Movado than it is for Fossil. So far, all my measures that I'm looking at, Fossil seems to be a more liquid company. Let's move along to accounts payable management. Accounts payable are sometimes referred to as trade credit. It's when the company purchases goods and services, part of its usual customary business transactions. It's likely to be a large source of short-term credit for the company, and the advantage of accounts payable is that there's typically no interest involved. So if the company is buying from its suppliers on account, it is basically an interest-free loan that it's receiving from the supplier. But payment is typically very, very short-term. Oftentimes 30 to 45 days the company has this free loan. A company conserves cash by delaying payments to vendors for credit purchases. Companies may want to take advantage of discounts that are offered for early payment. So if the vendor does offer a discount, then the company might want to think about that trade-off. How much would I save versus what am I going to, is there something more productive I can do with this cash instead of paying my supplier back? Perhaps I can give up that discount, but I can do something more productive with the cash. Another option is lines of credit. Lines of credit may be used to pay trade accounts or accounts payable with borrowed funds. This is typically going to be used when the company really, really needs cash, an illiquid company. A line of credit is just simply a bank offers you money that you can borrow when you need it. And so there's no interest. It's there if you need it. Think about a credit card. That's a line of credit. It's there if you need it. You're not paying any interest if you're not using it. But if you want to take advantage of that line of credit, you have it there for you. We can evaluate a company's ability to delay payment to vendors, or sometimes we call these creditors. Because remember, we want them to be able to do that. This is free. Rather than paying the cash to pay a bill today, you do other things with this cash. Accounts payable turnover measures the number of times per year a company pays its supplier. Vendors. And the accounts payable turnover is calculated as cost of goods sold, because most of our accounts payable arise from the purchases of the company's raw materials or inventory if it's a merchandiser and buying finished goods. Cost of goods sold divided by average accounts payable. Convert the accounts payable turnover ratio into a measure of the average number of days that a company takes to pay its suppliers. Accounts payable deferral period is defined as 365, because we're taking all of our income statement information for a full year, 365 divided by the accounts payable turnover ratio. Managers and investors, they want payments on account payable to be an optimal balance that avoids being either too slow or too long, because that could be an indication of liquidity issues and could result in the problems with the vendors not wanting to sell to us anymore because we're not paying them back. But we don't want to be paying them too quickly, because then we're not taking advantage of the free financing. And let's take a look at our accounts payable turnover and the accounts payable deferral period for Movado. Accounts payable turnover, I want cost of goods sold divided by average accounts payable. I see a number of 7.41. That's a decrease over the 3-year period. And I see that these numbers are high. There was also a decrease in the accounts payable turnover for Fossil. And Movado has numbers, the accounts payable turnover, that are higher. How about the accounts payable deferral period? Number of times that the company is paying to its suppliers. I see that increased from 37 to about 49, and that's of course significantly lower than what we see for Fossil. So we would say that Movado is making payments to its suppliers more quickly. Is that good or bad? We want them to pay slowly so that they're taking advantage of the free financing. We want to look at this together with other measures of liquidity because we don't want it to be because of, we don't want them to take longer because they're having liquidity issues. The cash conversion cycle is the amount of time it takes a company to convert inventory to cash while maximizing the amount of time that it takes to pay its vendors. So the cash conversion cycle is simply just the sum of the inventory conversion period plus the receivables collection period. And then from that, we subtract out the payables deferral period. Because these first two measures are where cash is tied up. And from that, we subtract where we are tying up somebody else's cash. The lower the cash conversion cycle, the better, for the same reason that we want the operating cycle to be low. We want to be able to use our cash as productively as possible to generate gross profit and operating income. Let's calculate the cash conversion cycle. This is easy once we've already done our other three measures. We take our inventory conversion, or let's start with our receivables collection period, plus our inventory conversion period, and from that we subtract our accounts payable deferral period. So we see a deterioration in the cash conversion cycle for Movado, and we see that Fossil has a more favorable cash conversion cycle than Movado does. Here are 4 additional measures of working capital adequacy. Let's start by looking at the current ratio. Current ratio is equal to current assets divided by current liabilities. And remember with working capital was the difference between current assets and current liabilities. So it gave us a dollar amount. The current ratio is a comparison. How many times greater are your current assets than the current liabilities? And let's write that down. Measures the number of times that current assets exceed current liabilities. Current ratios really depend, they vary dramatically based on industry, but typically we want to see a current ratio greater than or equal to 1. We want a company to have at least as much in current assets as it does in its liabilities. It's used to evaluate, well, it's a measure of liquidity, so it's used to evaluate a company's ability to pay its short-term obligations. Higher numbers indicate stronger liquidity. Increasing values over time indicate improving liquidity. In other words, a company is better able to pay off its short-term bills, and it's very widely used. Let's look at one deviation of a derivative of the current ratio. Quick ratio, otherwise known as the acid test ratio, is equal to cash and equivalents. We're going to see cash and equivalents reported together on the balance sheet, plus marketable securities, this is another way of saying short-term investments, plus receivables. Let's compare the sum of cash and equivalents, marketable securities, and receivables to our current liabilities. Notice we don't have any average values here. Why is that? How come in some of our earlier measures we used a denominator of averages? Well, that was only when our numerator was an amount from the income statement. Income statement covers a period of time. The balance sheet is at one point in time. Here we have balance sheet measures both in the numerator and the denominator. What's different about the quick ratio as compared to the current ratio? Well, the quick ratio does not include what major current asset? Inventory. Why is that? Well, we need to pay off our current liabilities. Of course, we can do that with cash or our short-term investments. Hopefully we'll collect our receivables quickly, or we can always factor and sell off our receivables for cash. But if we're stuck with inventory, we can't simply use that inventory to pay off a bill. So this is a more strict or stringent or conservative test of liquidity than the current ratio because it only includes the more liquid assets. Otherwise, the results can be interpreted similarly. So similar to those of the current ratio. Yet another derivative of the current ratio and the quick ratio is the cash ratio. The cash ratio is simply the cash and equivalents divided by current liabilities. So let's not worry about not even inventory. Let's not even include our marketable securities, our short-term investments, or those receivables. Let's just look at how cash compares to current liabilities. And this is the most strict or most stringent, or we can say the most conservative test of liquidity, because it excludes all other current assets in the numerator, only includes cash. Results can be interpreted similarly to the ones we used before, the current ratio and the quick ratio. Higher, the more liquid the company is. But too high of a cash ratio might be a bad thing. It might indicate idle cash, or in other words, inefficiency. We don't want our companies to have too much cash sitting on the balance sheet. It should be doing something, making productive use of that cash. Let's take a look at these measures of liquidity for Movado. Current ratio, I need current assets divided by current liabilities. I see that the current ratio is declining over time, but there's still current assets are still about 4 times as large as the current liabilities. It's fairly high, so I'm not concerned about liquidity here, but when I compare it to Fossil, it looks as if perhaps Fossil is making more productive use of its cash. Let's look at the more strict tests. Let's try the quick ratio, which is going to be equal to the cash and equivalents and receivables. There's no marketable securities here, otherwise I would have included them. Divide that by the total current liabilities. See a similar, very small decrease in the quick ratio, and then finally the cash ratio, which is simply going to be the company's cash divided by current liabilities. So of course our cash ratio must be lower than our quick ratio, assuming that we had receivables so that these numbers differ, lower than or equal to, and of course our quick ratio must be lower than or equal to the current ratio. I see similar patterns in each of these three when I compare them to the amounts to Fossil. Our last measure of liquidity is called the working capital turnover. Working capital turnover is equivalent to a company's sales divided by average working capital. It's a measure of how effective a company is at generating sales, obviously, that's on the numerator, based on the funds that are used in operations. So of course, the higher the working capital turnover, the better. But we could end up with an issue here. Higher ratios implies that the company is doing a relatively good job in converting its working capital into sales, but too high of a ratio implies that there might not be enough capital in place to support operations. Maybe we could be doing more. Too low of a ratio implies that too much money is invested in current assets. And so therefore there could be some inefficiency. Look at the working capital turnover of Movado and compare it to that of Fossil. Working capital turnover, I want sales divided by average working capital. Since I have working capital here on my analysis page, I return here, and I see that I only have working capital. I can't do average working capital. You see this number is not exactly right because it's taking the average. The income statement number is fine, but the working capital, I need to go one more year back to get the working capital so that my denominator here matches the denominator here. It's taking the proper average. So what can I say about the working capital ratio? It's decreasing over time. We're producing fewer sales with the amount of working capital that we have over time. And for fossils actually has a lower working capital ratio. So we see that Movado is doing a better job making use of its working capital to produce sales.